Thanks for joining us today. We're going to be talking about how to finance the student net and look at why you invest in student nets. So to kick things off, a bit about me. My name is Jeni Brown. I'm the sales director here at Mortgages for Business. So I've got lots of qualifications after my name. I've worked in the financial services industry for many, many years, probably longer than I really want to admit to. And we did a rough estimate based on the number of years I've been here versus the number of cases I've placed each year for my clients. And we reckon I've done over 7,000 mortgage applications. So I'd like to think that I come with some experience. In addition to that, I'm also a buy-to-let landlord myself. I don't have any student lets, but I do have two buy-to-lets. One, an apartment which I own through a limited company, which I bought just before the stamp duty changes came in. And the second is a property which I used to live in, which I then retained and rented out when I moved in with my partner. So not only experienced in the mortgage side of things, but also a landlord myself. So in terms of what we're going to cover off today, we're going to look at why people invest in student property and just give you an idea of some things to consider when you're looking at investing. And then we're going to talk in quite a large amount of detail about student net mortgages. And then we're going to answer any questions that you might have. To give you a guide, we expect today to last around 45 minutes, depending on how many questions there are at the end. And if you do have questions, if you type them into the box on your screen, but we're not going to be answering them until the very end, unless you've got any problems with sound and stuff, in which case we'll be picking those up here. Okay, so let's crack on then. So first of all, why do people invest in student lets? And I think the first thing it's really important to talk about is demand. So to give you some context around this, 2018 was a record year for the number of young people going to university. According to UCAS data, 27.9% of 18-year-olds in England were accepted onto a university course, closely followed by 26.3% in Wales and 25.9% in Scotland. And this equates to 363,960 UK students in total, demonstrating a continued and ever-growing demand for higher education. Not only is the UK desire for higher education increasing, but the number of international students has continued to steadily grow, with an increase of 4% in students coming from outside the EU in 2018. Seemingly, despite the average student coming out of university with more debt than ever, this has not hindered market growth. Whilst at university, around 54% of students rent rooms or houses from private landlords, and this is largely due to the lack of university-owned accommodation, a problem which is unlikely to be reversed. Another reason that people like to invest in student nets is yield. The average cost a student pays for their accommodation is £125 per week, varying from £104 in Yorkshire to £161 a week in London. If you buy a property and let to multiple students, you tend to see a greater level of rent than if you were letting the property to a single family. As a guide, Nottingham, which has a student population of over 37,000 students, yielded in the NG1 postcode a yield of 11.99%, and Liverpool postcode L7 coming at 9.79%. Conversely, London N6 postcode had the worst yield at 1.93%, but do keep in mind that the average property value in this area is £1.5 million. But as you can see, there really is a strong return to be made on your investment. The third reason we think people like to invest in student nets is really economic robustness. So what we've seen, despite being mid-Brexit, is that the number of students has increased, which means that whilst the letting market, according to some reports at least, may have been quite quiet recently, this part of the private rental sector has proved to be more robust, with some investors feeling that they're less exposed to economic volatility. In terms of some things to think about when you're considering investing, location is really, really important. So the average student lives within a 20-minute walk of their university. Most universities have some really strict rules around letting cars on campus or are city centre based. So it's really very common for students to rely purely on walking or public transport. So location for the students is absolutely key. Another thing you need to think about is how you're actually going to let the property. So some landlords will let to each student on a separate AST, and this does seem to be the more common option. However, other landlords will let to their students on a single tenancy. So what I mean by this is that they're all jointly liable under the one tenancy agreement. There are reasons why one option may be preferable to the other, but it's worth setting out your stall early on this so you can approach your marketing of the property effectively. Timing is really important. So as shown by recent research by Save the Student, students start the hunt for their next year's accommodation almost as soon as they go back to the new academic year. Competition for the best house fits. And this is unusual compared to standard buy-to-let properties, as it allows landlords to fill the space often 6 months in advance. However, if you are bringing a new property onto the student market, it's crucial to make sure it's ready to be marketed at the right time. 57% of students will have already looked for property source for their next year's accommodation for February, ready for their return in the autumn. Excuse me. The condition of property is also really important, and I think it's fair to say that the days of digs are over, and students are much more discerning in terms of their expectations on the quality of their accommodation. The Fit for Habitation Act, which students are becoming very aware of, means that properties with issues such as damp, if not dealt with promptly and efficiently, can mean you're breaking the law. So it's really important that you're committed to providing a product to your tenants which is up to standard. It's also really worth familiarising yourself with the HMO licensing requirements in the area where you're looking to invest, and also whether the property is in an Article 4 area. Article 4 is less than known about in HMO licensing, so just to explain this a little further, it's essentially where the property to be run as a small HMO needs to be given change of use. Even if a property does not perform to needing HMO licensing, this does not necessarily mean it's exempt from Article 4 and vice versa. So moving on to getting a mortgage on a student let. So first of all, looking at the options between HMO and traditional buy-to-let mortgages. So some buy-to-let mortgages will allow you to rent the property to multiple tenants, as long as they're on a single AST, with generally speaking no more than 4 sharers. Deals from these lenders tend to come in on the lower pricing levels, however they are clearly not appropriate for most student lets. One thing to be wary of here, lenders, whilst accepting that you will rent to multiple students, will base the rent on a single family let when assessing the property rental figure. And this can mean that a lower rental figure is predicted, and this can then have a knock-on effect to how much you can borrow, and we'll talk about that more in a few minutes. If you're to let to 5 or more students, we'll be having any number of students with each on an individual tenancy, which is a very standard way of running this, then you'll need to take an HMO mortgage. HMO in the mortgage world is slightly different to HMO in terms of licensing. From a lender's perspective, irrespective of whether the property needs a licence or not, the number of tenants, or whether the property is in an Article 4 area, if you're going to have separate tenancies for each student, then you'd need to take an HMO mortgage. And these are more expensive than a standard buy-to-let mortgage, but what I'd also add is that the pricing of these types of products is reducing, and they're now the most competitive I've ever seen. We'll come back to rates in a few moments. So in terms of how much you can borrow, when trying to figure out how much you can borrow, there are 2 numbers which come into play. Firstly, the maximum loan to value the lender is willing to offer on the product. 85% loan to value is the maximum, i.e. a 15% deposit from you, but the pricing is incredibly toppy at this level. The lowest rates come in at 60% borrowing or below, with a whole suite of options in between. However, the rental income would then need to support this level of borrowing, and this is driven by a calculation, which is commonly referred to as the rental calculation or the stress test. The stress test is a calculation to ensure that the rental income will cover both the mortgage interest payment plus leave a surplus to give the borrower room to build a fund to cover repairs, void periods, tax bills and so on. The way this is generally expressed is that the rent needs to cover the mortgage interest by either 125% for limited companies and base rate taxpayers and 145% for personal borrowers who fall into the higher rate tax bracket, assuming an interest rate of either 5.5% or the mortgage interest rate if you were to take a 5-year fixed rate product. Some lenders use a higher calculation for HMOs, so between 160 and 180% coverage, on the basis that the maintenance costs are generally higher, plus you'll have more regular voids owing to the more transient nature of these tenancies. Now, if you ever need to do this calculation, we do have a really good tool on our website, or indeed one of our consultants would be very happy to run through this with you for no charge or commitment on your part. The very good news here is that as student lets tend to yield incredibly well, the rental calculation tends to work out okay most of the time, and the borrower can invariably get to the level of borrowing that they require. In terms of the kind of rates that are coming alongside of student lettings, alluded to earlier, The rates do vary depending on the setup of the tenancy and thus what type of product you're going for. The loan to value and also whether you are buying personally or through a company will also influence the pricing. So to give you an idea, the rate for a personally held buy-to-let, which will be on a single AST at 60% loan to value, will cost from 1.39% upwards. At 75%, you're looking at 1.68% plus. HMO mortgages start at 2.89% at 60% loan to value and 2.94% at 75%. However, this is for a 5-bed property to be held in personal names. The majority of the deals we see are for 6 to 8 bedroom properties being purchased through a company. And what I would say is that in this bracket, the rates tend to sit at around 3.5%. There is quite a bit of complexity in terms of choosing products, in particular balancing setup fees versus interest rates. So it's always worth asking a broker to do the maths for you, see how this lands. We don't charge for providing quotes, it's always worth dropping us a line and letting us do the legwork for you. In terms of the types of properties which are acceptable on buy-to-lets and HMOs, there's no real set of rules here. Of course, you want to choose a property which will be appealing to the students, but other than this, the world is largely your oyster. As always, if the property is above commercial, high-rise, expert authority, say construction or new build, you will find that some of this may duck out. Proper student accommodation, i.e. a property which is usage classification to be used only as student accommodation, is a fairly niche part of the market. And while there are lenders who can consider this, there is a significantly reduced appetite to lend on these owing to the small resale market. I guess the key here is that students rent flats, not just houses, and the bigger the property, and by this I mean the number of letting rooms, the less options you'll have for finance. Which leads me nicely onto, is there a maximum number of students per property? The very short answer is no. As mentioned, some lenders cap out at 4 students. In the HMO world, 6 to 8 is very standard. However, there are products where you can take a 20-room property, and if you're happy to move into the commercial mortgage world, there really is no limit. Do also just keep in mind that your HMO licence may restrict how many students you can have in the property. In terms of whether you should be buying via a limited company or in personal names, from the perspective of getting finance, both are absolutely fine, and there's got plenty of options for either. Although, as previously mentioned, the pricing is sometimes higher for limited company borrowing. The decision of whether you purchase personally or through a company, which will be one which is generally driven by tax planning, is such I really cannot recommend highly enough that you get advice from an accountant. As a guide, over 50% of all purchase business we see is done via a limited company structure. But whether this is right for you needs some input from the appropriately qualified people. In terms of the finer details of limited company borrowing, this is a whole different webinar. There are lots of information on our website, or indeed just feel free to give us a call to chat it through. One of the questions we get asked a lot is whether you need experience to get a student-led mortgage. So for the smaller student-lets, where they're taking a single tenancy, you don't need to have letting experience, although most lenders will want you to own a property already. For the larger properties, or those with individual tenancies, the majority of lenders will want you to have some letting experience. This may have been having owned a buy-to-let for 6 months. Some lenders want you to have owned at least 2 properties for 2 years, and these don't have to have been HMOs. The key is that if you take on a 6-bedroom student-led, then you go from having no letting experience at all to managing 6 separate tenants, which really could prove to be a baptism of fire. Having said that, some lenders do not require experience, but do have a minimum personal income requirement, and this ranges between $40,000 and $80,000 a year. And there is one lender who doesn't have a requirement either for experience or a minimum income. So in conclusion, strong yielding properties with a healthy and growing tenant demand, which are financed relatively simply, especially if you're getting advice from the right people. So we're going to open the door to some questions now, which you're very welcome to type in, and I'll endeavour to respond to them as well as I can. And if those who aren't staying around for questions, thank you so much for joining us today. Okay, so no one seems to have any questions, which I hope is a positive sign. We've answered everything you may think of. Yes, thank you so much for joining us today. We really appreciate it. And if you have any feedback on the webinar, or indeed any questions with regards to anything finance related, you're very welcome to contact me directly. You'll see in front of you on the screen my details. Yeah, so thanks ever so much and have a great afternoon. Thanks.